Good evening, everyone. Thank you for joining us today. Today we have Hugh Hendry, who is the founder of Eclectica Funds. So how are you doing, Hugh?
I'm very well, thank you. I must clarify that everything you said there has to be noted in the past tense. I ran the iconic global macro fund called Eclectica from 2002 to 2017. But I closed it down at the end of that year. So 15 years of service. And now I'm a free floating spirit.
Okay, then. So could you just tell us a bit about your background? How did you get into the field of finance?
God decided for me. I was a very strange child. Think of me as a you may have worked it out already, but I am kind of the original Benjamin Button. I'm living my life in reverse, hence my circus appearance. Which is to say, I was a very studious kid, really from the age of 12 onwards, and I came from the banlieue. I came from kind of a rather impoverished background. And remarkably, I decided on my own that education would be a passport to get myself out. There was something about Scotland, the grey skies, that propelled me to seek avenues elsewhere. So I was not a normal member of the financial tribe, and I enjoyed God's hand, great fortune, and I ended up receiving a wonderful education in Edinburgh with an investment management house before moving to London. And then within a year, I had found Chris Benodi, and I began working with the Odie hedge fund, and I managed to navigate the tech crash of 1999. To 2002, with some aplomb in a fund where the investment mandate was rather restrictive, no shorting, etc. We managed to not only preserve all of the value, but I think over 3 years eke out a very modest profit. And with that platform, I was able to then launch the Eclectica hedge fund in 2002, and that fund again was unusual. And it was established to run at a different cadence to everyone else. So I was charged, like all hedge funds, but I think I took it more to heart than some. I was charged with not losing money and not correlating with other risk assets. And I think I want to say that's something I achieved. People always think it's some kind of competition, and I always get emails saying, "Oh, my performance is much better than yours." Fine, my performance was a function of being prepared at any point, whereby if we had the dislocation, I'm not sure how I would have fared with COVID, but with the dislocations that we saw in 2008 and at other times, that I would deliver profits. I certainly did that in 2008. So over the 15-year life of the fund, I compounded at 8%, and the notable points were making 50%, 50, in the first calendar year, 2003, when I was amongst the first professional hedge funds to really latch on to gold. And then again, I made 50% in the month of October 2008 to secure a 32% gain for that calendar year. Those are the ones that stand out.
Well, many just look at absolute returns, but having a non-correlated compounded annual growth rate is extremely valuable from a portfolio standpoint. So you mentioned 2008. You had a very great year. Markets were down double digits while your fund was up, what was it, more than 30%? So
yes.
How did you achieve that? What did you do? What was the right things you did? And what was your view and your positioning at that time?
Well, I'm actually writing a memoir, and before you all fall asleep, it's a memoir with a difference. I don't think this has ever been written before. This is an attempt to kind of to make hedge fund a hedge fund story on a par with a rock and roll memoir. We'll see. You can scoff at me later, but I have that. I have 2008 fresh in my mind, freshly stamped in my mind, because I've been writing about it for the book, and there are many wow factors about that time. From great distance and seeing the performance that I recorded, it really doesn't tell the story. It doesn't tell the story at all. I thought I'd blown it. Why did I think I'd blown it? The devilish, I would say, amoral behavior, not only of the investment banks. Once, to their great horror, they discovered just how lame and stupid they had been with regard to not only being long these mortgage, these CDS, these actually owning these pooled portfolios of mortgages across the United States, but having sold the underlying insurance on those bonds, defaulting. That it wasn't like 2x leverage. They discovered they had a quadzillion of leverage, a leverage that would kill them. The conceit, we call it, the conceit of a well-formed argument. And there was a well-formed argument. It was nonsense, but it was well-formed. And it was probably, there were two founding principles to it. First of all, we had the tech crash. And remember, the NASDAQ index had lost 80% of its value. And to put that into common parlance or common language, that's to say that Amazon fell from $115 to $5. It truly was the most viscerating decline. That it was a 1 in 100 year event, and so that had occurred. That was very much in the rear view mirror, and I think some of these banks reasoned, well, okay, we've got another 100 years before we have to worry about that. But really, the conceit came from being trapped in this notion that the United States would never endure. But certainly there was precedent. It had, so we can say again, past tense, and definitively, it had never suffered a nationwide house price collapse. And the presumption was that, if you will, with Microsoft and Boeing in the north, with Silicon Valley in the west, with Wall Street in the east, and with all that Texan oil pumping out of the ground in the south, then there was such economic diversity that it was very, very much unlikely. It was almost regarded as, preposterously, it was regarded as a black swan that could ever happen. And clearly that was the trap that sunk Bear Stearns, Lehman Brothers, Washington Mutual. I'll tell you a funny thing. In my investment letter of July 2003, I was short Lehman Brothers, Fannie Mae, Freddie Mac, Washington Mutual, and Countrywide Financial.
2003.
Short the entire 2003. Okay. Was I short for a long time? We wouldn't be having this conversation if I'd been short for a long time. Let's take Wells Fargo. Wells Fargo is bigger, but remarkably similar to Washington Mutual. Now we don't have a priced series to go back and consider, so we can use Wells Fargo, I believe, as a relevant trail of events. Like Washington Mutual, only about 15% of their income actually was being derived from this, on the face of it, boring old mortgage business. And their exposure to California was as great as Washington Mutual. But the gods deigned that Wells Fargo would live and Washington Mutual would wither. But anyway, Wells Fargo, heavens, I'm now going to have to make up the price. Yeah, I'm pretty sure Wells Fargo, at the bottom of the tech crash, okay, so Wells Fargo was not a tech company, but this cascading waterfall of stock prices brought everything down. And Wells Fargo, at the end of 2002, traded for $15, and at the peak, it traded at $45. So it went up 300% in 4 or 5 years. And what's big deal? The big deal is the peak price for Wells Fargo was about a week or 10 days before the bankruptcy of Lehman Brothers, right? And so again, then I was short in the summer of 2003, which is too early. And yet the peak, in terms of the peak rate of growth in the US housing market, was recorded 1 year later in 2004. And by the end of 2005, house prices were falling. And remember, the denouement was October 2008. So keep that in mind. The end of 2005, house prices are now falling. Not a lot, but they're not going up, and they're modestly falling. And this thing keeps going higher. And then it was given a push, and a grotesque push, in the middle of September 2008, when global authorities banned the short selling of financial stocks. Why? Why? What would that change? All it meant was that the only honest men and women on the planet who could see the madness, who were seeking to defend their clients, and very reasonably had adopted short positions, these people were eliminated by this profound piece of thuggery by public government. So when people come back and they say, "Oh, you nasty hedge funds," really nasty governments. Anyway, so 2008 was a madhouse. I found myself, I had a multi-billion-dollar notional position resting on a $200 million hedge fund, which was predicated on the notion that this disaster was about to befall, and that we knew how the American authorities, we knew a component of how the authorities would react. They would react by slashing interest rates. After the tech collapse, rates had gone to 1, which was almost unprecedented. They were 0 in Japan. And so, of course, we reasoned they would go to 0 in the US, like Japan. But given this power to kind of hide things under the carpet, we weren't sure as to when that denouement, that moment of gapping behind the curtain going, "Oh my God." And remember, it was like a science fiction movie. And I remember springtime 2007, and I met Greg Lippmann from Deutsche Bank, who features in the Big Short. And when he was finished telling the story for the 4th time, because I'm kind of dumb, you need to tell me complex things 3-4 times before I get it. But when I got it, it's like one of these cheap science fiction movies where the government knows that the sun is about to explode, that our universe is over, that every man, woman, and child, and dog, and cat, and llama on the planet is going to be wiped out. And there's maybe 100 people in the world that know this. And I was one of them. And you look around, you think, wow. You know, the burden of that weight on your shoulders was insane. Made even more crazy when my custodian bank, so in Europe, more and more in the US, you know, Bernie Madoff did not have this. You have a custodian bank, which independently verifies the prices of every single security in your portfolio and, if you will, verifies the market for when when investors come in around monthly, quarterly, etc. And my custodian could not understand how the pricing mechanism, and was worried about the independence of the pricing mechanism for these CDS securities. They were new, CDOs, etc. They were new. And so they rejected my request. Can you believe I discovered the sun is about to expire? I bought myself like this Charlie and the Chocolate Factory gold ticket to get onto the rocket, which is going to take me and a few other wise people to another universe. And my custodian bank says, nope, sorry, can't let you on, not with that ticket. And so that's when we basically created a 3-year forward rate steepener. I bet that the gap between the 2-year and the 10-year, but predicated on where it would be in 3 years' time, would explode. At that time, that spread was 0. And we knew that in other times of stress, it had blown out to 300. And we had about $1 million resting on every tick. And as it transpired, at the end, we cleared about $250 million from that trade. But we had to wait until midnight. Yeah, at 5 to midnight, which was February of 2008, or March 2008, February, March 2008, we'd made $50 million, the catalyst being Bear Stearns. But again, the market is this devilish and insane and malign opponent. It doesn't, don't take it personally. I take it personally. It doesn't like you. It doesn't want you to make money. And that crazy damn market decided that the Fed's got it. The Fed had been slashing rates. The Fed's got it. They've dealt with Bear Stearns in JP Morgan. And really, now it's looking 2 years out, because this was the following year, 2 years out, these guys are going to have to raise rates. I mean, the world is booming. And indeed, those idiots in Europe were raising interest rates. Across the world, central banks were raising interest rates. Oil was exponentially rising and hitting $150. That was the background. So when we look back and we say, hey, you made money, you made 32% in 2008, well done. I tell you, I was not sure of that until I made it on the week following the bankruptcy of Lehman Brothers. So there you go.
That's a very interesting story. So after 2008, we saw a huge difference between the United States performance and Europe as a whole. So do you have any opinion on why was that? Why is there such a huge difference between performance of the United States after the 2008 crisis and Europe?
Yes, I think it's quite simple, and it reflects the constituency of the indices that America has in its genius, the genius of Coca-Cola, the genius of listening to the Rolling Stones when you're driving through LA, and a million other fragments of the Americana. America has created a culture which brings people from the rest of the world to America to network and create and mold and fuse and build these astonishing companies. And we live at a time when these giant technology companies, the Amazons of this world, Googles, etc., Facebook, the components within Microsoft, and they are arguably amongst the greatest businesses ever conceived of in mankind. And they have a large element to them, which is riskless. And that riskless nature was demonstrated last year during this calamity, this alien invasion of our bodies via this virus. We had, the United Kingdom had its greatest economic contraction ever in 350 years. You know, UK has been subject to lots of kind of crazy things, having sovereigns that would wage war on other nations and famine, etc. Last year was the greatest ever economic contraction. So last year was an extraordinary year, and yet there are a number of these businesses in America which were unaffected. Businesses were largely what they were the previous year or higher. So to answer your question, America has a preponderance, it has a clustering that no other country in the world has, which make up the mainstay of its stock indices. And since 2008, we have been in an environment where officially recorded inflation rates, and when I say officially recorded, that sounds as if I am suggesting that there's something devious. I don't believe there is anything devious to them. Inflation has gradually decelerated further from low levels to very, very low levels. And it has meant that 10-year US government bonds have grinded towards zero. And businesses, stock analysis is made up of two parts. A business typically, well, not typically, a business can be deconstructed into a riskless component and a risky component. And 99% of businesses really is just risk. It's a risky proposition. This business is determined by the health or otherwise of the global economy. Europe just doesn't have many companies where the riskless component is big enough to be to move the gauge. Anyway, when 10-year treasuries trend towards zero, the value of a riskless business approaches infinity. There is literally no upper bound. So if 10-year treasuries, they've sold off this year. I mean, I was going to say modestly, but you know, their trend is still intact. Who knows? But they have sold off this year. First quarter, they were at the peak, they were down about 16-17%. And remember, those bonds are typically owned in leveraged portfolios, so it would be significant setback for the holders of US treasuries. But if that trend reasserts itself, then at 0 or 0.4% US treasuries, there is no upper bound to what a rational investor would be willing to pay for Amazon. So to answer your question, it is the absence of a clustering of very, very large cap stocks. Apple has a $3 trillion market capitalization. It is 40 times the size of the Icelandic economy. That, I think, that clustering and the trending of US security, US 10-year government securities towards zero accounts for the significant outperformance of the US stock market.
And with the huge size of these businesses, I'm astonished how they can still achieve a high growth rate. We're seeing Amazon, Facebook still achieve a high growth rate. So you've mentioned inflation a bit, so that's a great segue to my question. So we've seen a bunch of companies decide to raise prices on consumer goods, Coca-Cola, Kimberly-Clark, just to name a few. So these are companies that sell products that almost all consumers buy. And they all talk about commodity prices as the reason for increasing the price. So do you think that this trend of consumer brands increasing their prices, do you think this trend will continue? And will we see a huge effect on CPI metrics? And consequently, what is the effect on bond yields?
Well, bond yields were 10-year US government bonds were 17%, yielding 17% in 1980. Forgive me, my mind is foggy. 1980, 81, 40 years ago. and that was absurd. The Federal Reserve had raised interest rates into the recession created by the second oil price shock. And the first oil price shock back in 73, 74 was the deepest recession in the post-war. Incredible, we still talk about wars, but it was the deepest nominal contraction that many people had ever witnessed, lived through. And here we were with something on a similar magnitude, and the Federal Reserve was raising interest rates into a deep recession, and inflation was collapsing. So towards the summer of 1980 or 81, 17% government bonds were an absurdity, an aberration, something that should not have happened, and yet they did. 40 years later, that cycle is nearing completion, the cycle where US government securities have been the best performing securities, risk adjusted, in the world. That cycle is nearing the end. I kind of do believe in cycles which kind of last the length of an adult human life, 40, 50 years. It will end, I believe, in absurdity. I told you again, 2008, it was absolutely absurd that Wells Fargo should trade at $45, $46, $47, $48 on the 15th of September, 2008. US house prices had been falling for 2 years. Everyone knew that the banks were, and yet it traded at its, up until that point, at its all-time high. That was absurd. So I struggle enormously to believe that with good old Coca-Cola and Procter & Gamble raising prices, that's it. We're going to have inflation. I would strongly resist that temptation. Procter & Gamble, and to quote commodities, I made 50% in the calendar year 2003 because I was correct in determining the shape and the potential movements in commodity prices. Commodity prices, we had a decade of zooming higher. At one point, I managed the world's largest agricultural equity mutual fund. In 2007, we had $500 million in that strategy. And its legacy, the legacy of high commodity prices, has been 10-year government securities at 1%. So it's cute, but you're gonna have to try harder. And so let me help you. I wrote a paper, and if you type in the search engine for my name and the dawn of chaos, or better still, go to my website, and a pop-up will ask you to enter your email, and we'll send you the paper. In that paper, I accepted that inflation, the Milton Friedman comment, inflation is always has been, always will be, or whatever, a monetary phenomenon. It's a function of money printing. And I accept that wholeheartedly, but I felt it required a further, I felt it wasn't the entirety of the story. And the thing that I would add is that inflation is a function of human psychology. And the disinflation has been a function of social mood. Social mood is a better term. Social mood in the 1970s was, we were afraid. The 70s, afraid, I mean like burning a wire and it's coming apart. Our society was coming apart because our lives were insane. A group of Bedouin Arabs had got together and decided not to sell oil to America. And all other prices were rising alongside oil. Not many years before, an American president had been assassinated. His brother followed soon after. Today we say Black Lives Matter. Of course, Black Lives Matter. And it feels like the world is kind of very, very edgy and susceptible to further change. Back then we had soldiers on student campuses, killing people, killing kids in America. The Iranians, took American hostages, invaded the embassy, and America did nothing but plead and wring its hands and ask for their safe return. So the world was crazy, and that was a world when gold had traded at that point at its highest ever price. Gold in those 10 years, as people said, save me from this insanity. Gold had gone from $35 an ounce to $850 January of 1980. The last 40 years have been putting the genie back in the bottle and restoring order. So when the Federal Reserve was raising interest rates back then, it was saying, we're up to this task. It's going to be difficult, but we're going to achieve it. And they achieved it. And the last 40 years have been a function of, totalitarian regimes being brought down, people being freed. The average citizen's gone from earning $1 a day in China to earning about $10,000 a year. These are like the imposition of order. The world now makes more sense. Except, like I said to you, I suggested to you that we're probably nearing a change in that cycle, and that cycle will not reveal itself in Coca-Cola raising prices. It's revealing itself in social mood, which is becoming profoundly toxic. The first signs of it were Brexit. The UK has, as a society, UK has got a very, 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 very good track record at blowing the whistle on the end of things. The UK was the first nation to reject the gold standard and come off the gold standard, and in doing so, it spared itself the severity of the shock which then ensued. And the UK was the first of 27 nations to reject the euro. So that was the first sign. Trump was the second sign, and Trump is a sign of a very curious social democracy, knowing that it needs change and not being sure how to engage or find the catalyst for change. Trump is many things. I'll try and remove my own feelings. Trump was the first iteration of change, and there'll be more Trumps. There'll be Trump 2, Trump 3. I don't imagine it'll be him. I think it'll be other agents pursuing the same agenda for change. And then, I said Black Lives Matter. The shocking kind of brutality was seen in some quarters of the American police force. The eruption of anger. These are the things which I believe history will reveal as being the footprints of an emerging inflationary trend. In Japan, I want to say in 1936, 37, the military junta assassinated the central bank governor of the Bank of Japan because he tried to raise interest rates. That's dark social mood. So the thing that makes me think that inflation is more likely to arise, more likely now than it's been in 40 years, is the darkening of the social mood, not Procter & Gamble and Coca-Cola raising prices. There you go.
Well, I would say that Coca-Cola and Procter & Gamble raising prices is also going to affect the social mood, right? Because everyone's going to be affected by it, although the change might be small or minuscule. But since we're seeing this societal change with all the things that are happening in the United States, we might see a better movement towards modern monetary theory, MMT. So do you think that more and more people would accept MMT? And I would really want to hear your thoughts on what do you think about MMT? Do you think they have the right solutions?
I don't like titles. MMT is for people to write books about. The world of economics is really quite simple. It's determined by the behavior. Yeah, I'm a behaviorist. I guess I'm more of a behavioral scientist. Well, you could possibly call me a scientist. You don't need MMT. You don't need narratives of that nature. You need banks to be encouraged, and you need banks to be risk-taking. They're going to be encouraged to take risk, and they're going to be willing to take risks. And so again, part of my nonchalance with regard to inflation, and nonchalance I would add, which is shared by the capital markets. If you read the Financial Times and Wall Street Journals, you would believe that experts, and I hate that term, experts, are terrified about inflation. They're not. There's an inversion in the inflation curve. 5-year spot inflation expectations are like that, which is your Coca-Cola and Procter & Gamble. We just destroyed capacity. We've just kind of rejected globalization. We've just had factories and shops and services closed for over a year. Prices are rising, kind of necessarily, and for economic reasons, and I think that will abate. 5-year forward is down here. So 5-year spots here, but the expectation of where that expectation will be in 5 years' time is like here. If you look at Euro-dollar futures and you go out 2-3 years, supposedly we're looking at 7% growth this year and 5% next year in terms of US GDP growth. Big numbers. Sure, the Fed saying we're never going to raise interest rates, but the Euro-dollar market always kind of ends up disagreeing, and the Euro-dollar market is the best indicator of wisdom and saying, no, actually, you say you're not going to do it, but you're going to do it. And all of those kind of smart, hawkish minds compressed into that Euro-dollar futures can see maybe raising rates by 25 basis points by the end of next year. So the market just doesn't buy it, I believe. Why doesn't the market buy it? I'm going to mention Wells Fargo again. Why not? They've all been producing results, quarterly earnings of late. And Wells Fargo reported a 15% decline in loans outstanding year over year. 4% increase in deposits. So people are saving more, banks are lending less. JP Morgan, I think, more representative, bigger bank. Same data, loans down 4%. Deposits surging 25%. That's why when people are telling you, oh, the money supply is surging, deposits up 24%. We stopped looking at that stupid data 20 years ago. It doesn't tell you anything. Deposits up 24%, people saving. The bank?
Not lending.
Not lending.
No.
Not lending. Okay. So again, begin to worry about inflation when JP Morgan is reporting earnings. You've got to see bank loan growth at GDP growth or greater. In my world, that's what the policy should be. So MMT? We should, I should answer it, try and rebuke it directly. I would say Japan has been practicing MMT since the early 1990s. It is demonstrated that a sovereign nation that has its own currency is somewhat unlimited in the paper fiat currency units that it can create. It's taken its debt to GDP from very, very little to very, very high levels. I want to say 250, 270% of GDP. Hasn't achieved anything. Why has it not achieved anything? Because the genius of our world is it's not governments. I was on a panel. There's a show in the UK watched by about 3 million people. Question Time. I was on that, I don't know, 2011 or so. And the First Minister of Scotland is saying, I'll create jobs, I'm going to spend money, I'm going to do this. I would call that like an MMT rhetoric. And I said, I've got to stop you, but you don't create jobs. Jokers like me, we create jobs. Risk takers like me, we create jobs. You spend money, you spend my money, and you send me the tax bill, and people are employed. You create nothing. You don't. It's like China. China creates GDP growth at the expense of wealth. GDP growth's been, if you put it on a scale for the last 10 years, it's like that. If you're listening on an audio, it's to say it's gone from the left-hand side of the chart to the right-hand side. It's gone up, almost in a linear manner. Put the stock market on the same chart, and it's the opposite. China doesn't create, so spending money doesn't create wealth. And so it's only the genius of the private sector of this, of a mood against a social mood, of people being willing to sometimes risk everything for the genius of a new idea. That's what our worlds are founded upon. And MMT is not a solution to that. So that genius of ideas that comes from, we can split the economy into two parts, debtors and creditors. Debtors are these people with the Steve Jobs of this world who change our lives. But they typically start in garages and they have no money. And the genius of the market-based system is that it brings oddballs like that together with creditors, sovereign nations, rich people who've got lots of cash, but very few ideas on how to spend it. And it brings those two together, and the market interest rate allows them to transact. So that's why bank lending is so important. So I reject all isms, MMT-isms and socialisms and Keynesianisms, and except capitalism. I accept capitalism, albeit it's going through the last 200 years. This is the fourth iteration where capitalism's on its ass, and if we don't start getting things better, capitalism's going to be subject to a massive retracement.
The point about banks lending, that's a great point. People always talk about the money supply while not mentioning that the actual supply of money is lending. It's not going up. That's because, well, we're in a recession. Banks don't want to lose money, so they won't lend. So just to continue on MMT, just for a bit. So let's assume that the US adopts some kind of MMT, Japan-like MMT.
They have. They've announced in the last 12 months.
Yeah.
It's a $21 trillion economy, which has committed itself to spending the best part of $7 trillion now.
That's a good point. So from an investor standpoint, how should you position it? Should we not even think of inflation as a possibility? Because, not much of the money is moved. So how should you allocate to this scenario?
You should always think inflation is a relevant scenario. I wouldn't really be desperately seeking to change much in terms of how I would engage with the marketplace versus the last 10 years. Like I say, you would accept that Japan has pursued MMT. What was the winning investment strategy in Japan?
Everything went down.
Not everything went down. Everything's by and large gone up. Yields have gone down. Volatility's gone down. So there is no MMT strategy. There's no MMT investment strategy. You have to play very, very defensively. So would I own government bonds just now? No, I wouldn't. I'd be looking to buy government bonds. I'd be manically hoping that US Treasury securities back up to 2.5%, if not 3%. Because I think at the end of, if inflation is to be, for our future, is to be littered with very high levels of inflation, I'm sure that will only come from the absurdity, not of 17% interest rates, but 10-year rates being zero, if not negative. So I'd be looking to buy US Treasuries for that ultimate boom to the absurdity. But for now, I'd be long precious metals. You know, if Bitcoin is correcting now, if it corrected down to about 35,000, yeah, sure, I'd buy that. I'd own oil stocks just now. You know, again, social mood. Banks do not lend to carbon creating monsters. Great, okay. You know, don't commit. But guess what? You know, when you try and reach 2030, 2040, and 2050 zero carbons, the bit between inventing the technology and today, you're going to discover, and with the US economy growing at 7%, you're going to discover you need oil. I'd be long oil just now. I'd be long nuclear just now. I'd be long the risky companies just now. But as a trade, that was a trade that worked 2009 to the end of 2011. And we're on the same track today. It may last longer, but just now, it will not last longer if JP Morgan continue to contract their bank lending. That's all.
I mean, oil demand, you know, just, you have India, you have all these emerging markets. They need oil. So oil is not going anywhere for a very long time, so, in my opinion, even though I'm biased. So I would think oil is very hated at the moment. I mean, the market has given it some upside, but I think some is left. So you've mentioned, if you want to elaborate on that point, or should we go to the next question?
I mean, on oil, the only thing is that experts on oil traders, everyone is bullish. So upside oil, harder to determine. But in the stock market, a lot of the oil majors, you're able to buy them at the same prices that prevailed at the very lows of 2008. That feels like a kind of, it's contrarian, but it feels like, why not? It wouldn't be 100% of my portfolio, but yeah, that would be a component of my investment strategy.
So you've mentioned Bitcoin and precious metals. So do you think that this trend towards investing in Bitcoin, would that take away capital from gold? And would that trend, in a way, just disrupt gold as an asset class?
I think it has taken money away from gold. I don't think it will destroy gold as an asset class. So Bitcoin was kind of created in the image of gold in terms of having being limited. It's a finite rather than an infinite supply. So Bitcoin is the perfect riposte to March of last year. In March of last year, the Federal Reserve created dollars, the equivalent of 25. So what I want to say that 25% of all the dollars that have ever been created since the existence of American time, which is not that long, but it's long enough. A quarter of all those United States dollars were created in March 2000. That is the genius of Bitcoin. That is the genius of gold. So Bitcoin was created in the image of gold. In some respects, Bitcoin is better than gold. It is more finite, but more importantly, it is portable. You can transfer, you can leave a country and then engage with your wealth in a safer environment with Wi-Fi. However, even those 2 points are conjecture. It's hard to codify them as a fact, because Bitcoin has only existed for 12 years, whereas gold has existed since the beginning of time. So old man Bitcoin, gold, it has got just one incredible ace in the cards, the ace in the pack. It's always been there. It has always demonstrated that in a sticky situation, it's been your friend. Whereas Bitcoin, so again, let me tell it through Nassim Taleb. In his first book, he recounts the story of Renaissance Italy, and the Italians, in their magnificence, created banking and financial services, and they had life assurance. And Nassim tells the tale of this 50-year-old person, Italian man, and he's got life assurance. Whereas the 21-year-old kid, he can't get life assurance. And you think, that's kind of, 50 is an old age for someone back in the 15th, 16th century. But the rationale is, this 50-year-old guy, he's got form. Society and life was tough. He survived everything that life threw at him. So he's a good risk. The 21-year-old kid, who knows? Untested, unproven. So I don't think Bitcoin today in 2021 is going to destroy gold.
I mean, the return profile of gold and Bitcoin is completely different, yet people always compare them. I just find this interesting. So what would you say, just on your trading strategies yourself, what would you say is that something that is essential to your strategy that others would find unorthodox or unconventional, something that you do generally?
Look at me. I was born unorthodox. People would call me a moron, but the reality is I'm an oxymoron. And what is an oxymoron? So people would regard me as being contrarian, which I always found a very, very strange term. And I found it strange because, and if you want a rule, the rule is you should buy things which are going up, sell things which are falling. Really quite a simple business. And the contrarian or the oxymoronic aspect is the market, this collective grouping of people, from time to time becomes a contrarian, which is to say, and you've heard this repeatedly, oh, you got MMT. They'll create some packaging, some sexy and compelling logic behind it, but they will create a narrative which will then permit their minds to justify shorting something which is going up. Tesla's a great example, like that. All the great and the good have told you how insane it is. NASDAQ from 1998 to March 2000 is an example of that. These moments in time when the conceit and the arrogance of a well-formed argument permits money makers that should know better to challenge trend. So if I have a superpower, I have always been conscious of that internal fight and the great dangers that comes from the conceit of a well-formed argument.
I mean, it is way easier to just invest with the trend. It's way harder to bet against it. Many have, literally gone bankrupt.
Well, it's still hard to, again, prices seesaw within a trend. Again, remember, we are up against a vicious foe, a malign foe. The market does not want you to make money. and it will throw, the best investment story of all time is found in the Christian Bible. It's the only one I'm familiar with, forgive me my ignorance of the others. But you have these disciples, these opposites of the Almighty, of Jesus Christ. They have seen, some people think they've seen future inflation. Peter and Paul had found, were breaking bread with the Almighty. And he says to them, he said, "You're idiots." No, well, thank you very much. Why? Like, before the cock crows 3 times, you will have rejected me. Impossible. And of course, we know that came to pass. So what markets are all about is, it's the hardest thing on earth is to stick with the rising trend. Hardest thing. That's why it's so powerful.
So could you tell us about your best or worst investment or trade that you've ever had, and what have you learned from that?
I mean, best, buying gold in March, April 2003. Worst, not buying gold in March, April 2009, when the Fed introduced quantitative easing. Worst, going back to my formative years as an investment analyst in Edinburgh. I worked for a very, very fundamental, analytical company that controlled risk through searching, identifying, and investing in businesses, superior businesses, less risky businesses. And to try and make my mark, I was very ambitious. The dream of everyone in that business was to find and invest in a stock before Warren Buffett invested. Can you imagine that you buy the stock and then Warren Buffett buys the stock? And I convinced myself that Warren Buffett was about to buy Reader's Digest. And you probably have never even heard of Reader's Digest, because Reader's Digest went bankrupt, but not before IPOing. And Reader's Digest began in 1923. And Reader's Digest was a genius idea. It recycled last week's news, put it into a kind of handy little magazine format, and put some trashy other things in there. So the cost was zero. No journalists. The cost was zero. And somehow it was huge. It was the world's best-selling magazine. They sold it in Germany, in the UK, and France. They sold it in Japan. And each of those nations thought of that Reader's Digest as being British or German or French or Japanese. But at the same time, they thought of it through the prism of Coca-Cola as being somehow capturing a part of Americana. So zero cost, huge returns on capital, buying it through the glitch with the internet, etc. And I bought it. And the IPO was a disaster, and the price went down, and I bought more, and the price went down, and I rechecked all of my thinking, and I bought more. And the investment partners at that time tapped me on the shoulder and they sold the position. It was a catastrophe. The conceit and the arrogance of a well-formed argument. Better. So this is why no one will ever invest with me again. I used to dare people to invest with me. I am the safest investment manager you will ever come across, because I scare you.
So will you ever manage money again, or have you stopped completely?
The five-time winner of the Olympic, five-time winner of the Olympic rowing, the oarsman, Sir Steve Redmond, after I think the 4th time, he came out of the water, having just won. And he said, "Steve, are you over?" And he said, "If you see me in a boat again, you have my permission to kill me. Never, never, never." So the challenge is never say never. Who knows? I have I am like you and like half of the world. I also do podcasts, and I'm doing podcasts where I go back in time and I retrace my steps. As I started the hedge fund, and I review and look at the trades, and then I try and look to today and try and see if there's overlap and try and find insights for today. And I'm finding that my neural pathways are opening again. I'm kind of curious. So I would never dismiss it. It would have to be a very, very good offer. I could never work for anyone, but I would never say never.
So just moving to the last question. What advice would you give to listeners who are interested in the hedge fund industry? How should they go and try and work in the industry or create their own funds?
To work in the industry, it's hard. Glimmer and glow. So most of the kids turn up with an impeccable CV, picked up with internships here, there, and everywhere. The thing you've got to recognize when you get to that, not many people get to the point of being interviewed. You're there because you're intelligent. You're there because your background you've ticked a lot of boxes. That ain't going to get you the job. The thing that's going to get you the job is glimmering and glowing. It's the cult of the personality. I didn't just do that. And it's not, I was an entrepreneur at the age of 12 and I created a multi-million-dollar business, but now I want to be a hedge fund. It's none of that. It's something idiosyncratic. It is a burning volcano of enthusiasm. And not everyone has it. I had it. I had read everything. I could quote you Jesse Livermore, upside down, back to front, and everyone else, the Jack Schwager market wizard. It was just, I was clear and presently the most hyper enthusiastic person you'd ever met when it came to the world of hedge funds or of investing. Well, I didn't know what a hedge fund was when I started. I didn't know what a hedge fund was when I started working for a hedge fund. So that's what I would say. And for those seeking to invest, Bernie Madoff says it all. The guy's operation was set up to look. This industry is so prejudiced that there is an accepted way of doing things. After 2000, can you believe, 2003, I make 50%, and I make 8, I make 15, then get involved in what should have been the deal of a century, but idiots got in the way. I was trying to take over EMI, an EMI music company. Within it was royalties, music publishing. And I could see that interest rates, which were 5%, I think back, 10-year rates were 5% back then, rates were going to go to the floor. And so back then at 5, you kind of argue you should value it 20 times the gross cash flow from the riskless part. And that was twice what the market capitalization was back then. Today, that business would be worth much more. And it didn't happen. But then I nailed 2008. And in 2009, my assets under management were $50 million, $30 million. They went back to what they were at the beginning. No one was interested because I just looked like a head case. Maybe I speak like a head case. So if you're looking for an edge, you ain't going to get it on a telephone. If you're looking for the edge, he plays for U2, plays great guitar. If you're looking for an edge, try listening to the unconventional. That's what I would say.
Thank you, Hugh, for giving us your time. Anywhere you want to send the listeners to?
For sure, yeah. You can find me on Twitter. Twitter H_Hendry. Listen, I have no idea, but I'm on Twitter. The YouTube channel is Confession, so it's Hugh Hendry, my name, Hugh Hendry Official. I am the one and only .com, and you can keep up with me there. So thank you very much for having me. Thank you for having these excellent questions.